Welcome back to Alpha Recap. Juniper here with Brittany. Today we're unpacking how AI momentum, inflation worries, and sector rotation all collided during the trading day. As always, if you have questions, you can reach us at stockalpha.ai.
Hey everyone, Brittany here. We've got a lot to get to. Nvidia testing a key support, Oracle's big fourth quarter call coming up, an EU finding on Apple, and a UBS note about a potential memory supercycle. So buckle up.
Quick market framing. Equity futures had opened higher pre-bell, and the day finished with a short-term risk-on bias. But beneath that lift, several big narratives were colliding and creating dispersion across sectors.
Right. And the other thing is, the surface picture of risk-on didn't capture the cracks underneath. Tech showed both winners and clear stress points.
Let's start with the AI narrative and Nvidia. The stock slipped down to a technical support level during the sell-off, and that matters because so many strategies, from quant funds to retail algos, are keyed to those lines on the chart.
And the number that really caught our eye? Analysts have been watching whether that support would hold because a break could trigger algorithmic selling and force a broader re-rating across AI names.
Exactly. So, what really stands out here is that NVDA isn't just a single stock. It's become a benchmark for AI sentiment. Analysts note a decisive bounce would restore conviction in the AI trade, but a failure would amplify downside via stops and margin calls.
I mean, when you step back and look at this, it's really a test of whether the narrative is purely hype or if the earnings and bookings follow through.
That dovetails into Oracle. The company has rallied this year on AI positioning. Analysts have it up about 9% year-to-date in coverage. But the fiscal fourth quarter call was flagged as the moment of truth.
Hold on, say that again? 9% year-to-date? Wow. Okay, investors will be watching bookings, cloud revenue growth, and whether management can tie that AI positioning to real margins and recurring revenue.
Right. Analysts are saying narrative has to convert to top-line and margin evidence. If Oracle can show progress on data center buildouts and incremental margins from AI hosting, that supports the sector case. If not, the optimism looks fragile.
Short reaction.
Regulation showed up as a cross-cutting risk today. The European Commission publicly found that Apple had failed to bring an AI tool into compliance with EU rules. That raises practical execution risk for AI rollouts in Europe. Product changes, delays, maybe fines.
Yeah, that's not great for anyone counting on global consistency for AI features. Analysts emphasize this as an underappreciated localized enforcement risk.
And because Apple is a huge incumbent, this finding is a warning shot. Even the biggest players face regional enforcement that can alter product roadmaps.
Totally. Okay, pivot to memory. UBS put forward a pretty bullish view, suggesting a Micron-led memory supercycle driven by AI compute needs. That would be a multi-year lift for equipment vendors and memory suppliers.
A supercycle means sustained elevated demand, longer lead times, and predictable order flow. In plain terms, more capex from memory producers, steadier revenues for equipment makers, maybe higher multiples if the demand stickiness shows up in guidance.
But there's a counterpoint. MarketWatch and others flagged potential margin squeeze for hardware suppliers if consumer devices move to very high-end integrated designs. There were even reports of a next-gen video game console that could cost about $1,000.
That's the key tension. More compute demand, but uneven value capture. UBS and memory bulls expect equipment wins. Others worry component makers could get squeezed as OEMs and cloud providers capture more of the economics.
Short reaction.
Now let's talk macro. El Niño is back in the headlines as a potential inflationary force. MarketWatch and some strategists warned it could push commodity and food inflation higher, which would be a structural headwind for real purchasing power.
Yeah, that tracks. If El Niño drives commodity shocks, that changes the rotation story. You'd see money move toward real assets and inflation hedges, and maybe a rethink for duration and fixed income bets.
Analysts are split here. One camp sees meaningful pass-through to consumer prices. Others argue central bank credibility and inventory dynamics can blunt the shock. It matters because it affects sector leadership and rate expectations.
We had some interesting idiosyncratic winners today, too. Index mechanics were in play. Nicolette Bank shares was highlighted as trading at $144.06 and slated for an S&P 500 addition in June. Classic index-driven demand.
Columbia Financial has climbed about 23% over 6 months to roughly $20.76 after a solid first quarter. And RBC Bearings has surged to about $590.64. Huge 5-year gains and notable outperformance in the industrial space.
These are good reminders that not everything is about mega-cap tech. Index flows can create mechanical buyers, and idiosyncratic industrial winners can outperform for operational reasons.
Let's surface the market debates. First, is AI momentum sustainable without earnings? One side says the recent NVDA weakness and Oracle caution shows the rally needs earnings to justify multiples. The other side sees dips as buying opportunities in a multi-year secular cycle, provided companies execute and regulators don't intervene.
And then memory supercycle versus hardware margin squeeze. That's another major fork. UBS argues broad equipment wins. Skeptics say some hardware suppliers will be squeezed as consumers buy expensive integrated devices and value shifts to software and cloud.
Finally, inflation. Transitory disruption or a structural reacceleration? If El Niño drives sustained commodity pressure, portfolios may need to rotate. If central banks can dampen pass-through, markets might keep favoring growth.
Short reaction.
For different investor types, the implications were clear. Short-term traders were watching technicals like Nvidia support and volatility around Oracle and Apple headlines. Growth investors need earnings and execution from AI exposures. Value and income folks should consider inflation sensitivity.
And long-term allocators are being asked to think about regime shifts. If a memory supercycle materializes, semi-cap and equipment might deserve higher allocations. If El Niño reaccelerates inflation, real assets and inflation-sensitive hedges become more relevant.
A couple of tactical notes analysts were flagging. Reassess AI convictions by separating narrative risk from earnings risk. Stress test hardware exposures for margin pressure, and run scenario analysis for El Niño-driven commodity shocks.
Also, for those tracking index events, like Nicolette getting added to the S&P 500, consider how much recent performance is technical versus fundamental. Liquidity and ownership concentration can change volatility profiles after an index inclusion.
Let's be clear on the tone. Analysts broadly agree AI is a central structural theme, and that company execution will determine if narratives translate into lasting valuation gains. They also agree El Niño risks are non-trivial.
Where they diverge is on durability and breadth. Whether the AI rally is a buyable dip or a story that needs concrete revenue and margin proofs before more capital flows in. And whether equipment wins will be broad or selective.
Before we wrap, a quick reminder. This analysis is informational. It doesn't constitute personalized advice or a recommendation to buy, sell, or hold any security. Analysts note risks and data, and momentum indicates themes, but decisions require your own due diligence.
Final takeaways then. 1. The market closed with a constructive short-term tone, but beneath that, the intersection of AI execution risk, regulatory heat, possible memory demand acceleration, and inflation worries created far more complexity.
2. Watch 3 catalysts closely. Oracle's fiscal fourth quarter call, Nvidia's price action around that technical support, and any fresh developments on the Apple EU enforcement front. Those headlines could move sentiment quickly.
3. For portfolio reviews, separate narrative-driven exposures from fundamentals-driven ones. Stress test hardware margins and run scenarios for commodity shocks tied to El Niño.
4. Keep an eye on memory supply chain signals. If UBS's view starts showing up in CapEx cycles and order books, equipment names could get more visible. But the devil is in the demand sustainability.
All right, that's a wrap for today. If you have questions about anything we covered, head to stockalpha.ai, where you can ask us directly, and we'll answer live. For more market analysis and insights, visit stockalpha.ai.
Thanks for listening. We'll be back with more recaps and market context after the next trading day. Stay curious and reach out at stockalpha.ai with your questions.